Southeast Radio's Business Matters with Karl Fitzpatrick.
Well, with the economy improving and a reported improvement in consumer confidence, there is certainly more business being done. While this is very positive for business, it has created a new challenge for business owners, and that is cash flow management. Over the past few months, I've been contacted by more and more business people that find themselves with cash flow difficulties and don't know where to turn. Because of this morning I've invited Brendan Byrne of Charbran Services to discuss how business owners can prevent cash flow issues from occurring and how to deal with them if they do. Brendan, start by providing us with an insight into your experience in this area.
Well, Karl, I am a mentor and a trainer with Wexford Local Enterprise Office. I'm having experience of dealing with a large number of clients in the whole southeast region, focused in on Wicklow, Carlow, Kilkenny, Kildare, Laois. So a lot of experience, particularly in the whole cash flow management side of things, which have seen significant changes over the past 10 years.
And Brendan, I'm hearing that cash flow management is a big problem for many businesses across the southeast. Would you agree with this?
It's a significant challenge, Karl. The issue has been always that entrepreneurs don't fully understand when they start up that there's a substantial difference between profits and cash flow. You can't spend profits, you can spend cash. And it's important that entrepreneurs do understand the difference, because when you want to buy something, there's no sense telling somebody that you're going to give them money in the future. You need to be able to provide them with the cash there and then, or certainly knowledge that the cash is going to come in to complete the purchase.
And in your opinion, why is cash flow management such a problem for business owners at present?
It comes down to timing. The whole of the world's economy is based upon credit. You turn around and you look at a simple business, a retail business. You turn around and you buy, or should I say, you purchase a particular product, and then you hope you're going to sell it. The problem being that if you don't get paid by your customers, you can't pay your suppliers. So as you're starting off, you turn around and look for credit from your suppliers. If you're getting credit from your suppliers, they're potentially getting credit from their suppliers, and it becomes a chain. And ultimately, if there's a slowdown in the chain, it causes a problem. The second issue is if you want to expand, you turn around and decide that the particular area you're operating from, the shop or the retail setup, is too small, and you decide you want to increase your operation or you want to move. You need cash in order to do that.
And are businesses guilty of overtrading since the recession ended?
Overtrading, it can be complex, because what you're trying to do is you're trying to drive the business forward with a sufficient capital base. What do I mean by that? You don't have cash behind you or sufficient funding behind you. When you turn around and walk in to your warehouse, you see a certain level of inventory that the warehouse never drops below. The goods within the warehouse changes, but the level doesn't drop below a certain point. That means that that stock level is a constant and should be funded by a constant level of cash, so a long-term loan. If you turn around and try to build your business up on the basis of short-term credit, i.e. through overdraft or through financing from your suppliers, then you will run into problems, because you will run out of cash. If you're turning around and selling to your customers and providing them with credit, that'll cause a problem.
Now, surely one way to address cash flow problems could be for businesses to ask for upfront payments, but often there seems to be a reluctance to do this.
As I mentioned, the problem being that where is your customer going to get that particular finance from? You ultimately are dealing with, for argument's sake, an end consumer. You're involved, for argument's sake, supplying double glazing windows. So you turn around and you have a sale of maybe €5,000 or €6,000, and you're looking for €2,000 or €3,000 up front. That's a substantial amount of funds that the customer has to find, and they're taking the risk that you're going to turn around and complete the contract.
And specifically from a business-to-business perspective, would it be prudent for businesses to conduct research on their clients and to perform credit checks on prospective clients?
It's very important that you do assess the creditworthiness of your customers, particularly when you're looking at expanding and taking on new customers. The lure of a big transaction shouldn't cloud your judgment. You should carefully consider the level of credit you're willing to advance to a new customer, and make sure it's appropriate, taking into account the level of business currently being undertaken and the potential for future business. You shouldn't overly expose yourself to any one particular customer. You try and make sure that you spread out the risk as much as possible.
Now, if you've just tuned in, I'm speaking to the Managing Director of Char-Brent Services, Brendan Byrne. Brendan, on the subject of the collection of payments, how important is it to have a signed contract with clients and also to ensure that any changes which have been negotiated during the term of the contract with a client are reflected within this particular contract?
It's very important to set out what the expectations are in respect of any particular commercial agreement. That having been said, you could put a lot of effort into a particular contract. Unless you're willing to enforce that contract, it doesn't mean an awful lot. If you have a small transaction, it may not be worthwhile entering into a contract, but then you have to be aware you are taking a risk. If you have a large commercial undertaking, the contract may be justified, but if the margins are tight, you may need to make a decision of a risk-reward balance, because legal contracts are expensive to negotiate, to put in place. More importantly, they're only as useful as your willingness to enforce them. And that takes time and money, unfortunately.
And could the availability of flexible payment methods, such as standing orders or stage payments, help to improve cash flow positions?
Standing orders are very, very useful. I was speaking to a client recently who is involved with annual maintenance agreements, and they had never thought of standing orders, and they spent a lot of time and effort in collecting the annual payment. So they thought the whole idea of a standing order was very, very good because of the repetition. The second thing that is important is to turn around and make sure you're in contact with the customer while the customer still needs you. In this particular instance, this client I was talking to was involved with issuing certification for their particular product. And they had a tendency to issue the certification prior to payment. Why not withhold the certification until after the payment?
Now, what are your thoughts about companies that offer discounts for upfront or early payments?
Discounts for early payments can be useful to get cash in, but also they can be very expensive. You consider a contract where you're turning around and providing a 5% cash discount if you pay within, for argument's sake, 30 days, just to make life very simple. When you turn around and work out the cost of that over 12 monthly transactions, it can be very, very expensive. That having been said, if cash is tight, it may be something you have to do to bring cash in.
And how would you go about converting slow-paying customers into cash-on-delivery contracts?
You need to make sure that the customer turns around and sees value in the product you're providing. If you're in a situation where you are the only provider, then obviously you have a little bit more leverage. If, however, there are competitors, then it becomes a little bit more difficult. But through good customer relationships and strong service, you can show the value of dealing with you. And you can turn around and try and support the customer to ensure that they can turn around and generate cash from their customers and help them grow their business. And ultimately, that will benefit you.
Now, up to now in the interview, we've been focused on bringing about tactics and processes and procedures within the organisation that will help us to be able to get paid faster. But to flip our attention to the other side of the coin for a second, negotiating generous credit terms from your own suppliers could also be very beneficial.
Most definitely. There are three key elements to cash flow management. The three elements are inventory or stock. That's a great consumer of cash, because in the vast majority of businesses, inventory or stock doesn't generate any cash by sitting around, other than obviously wine or whiskey. That's if you're willing to leave it lie around long enough and not consume it all. Then we have our receivables or debtors. Again, you don't generate any money when you're owed cash from your customers. On the other side, however, you have your suppliers, and can they turn around and give you product with extended credit terms, which allows you then to turn around and extend those credit terms out to your customers.
And would you recommend that certain businesses obtain credit insurance?
Credit insurance can be quite difficult depending upon your customer base. Generally speaking, you'll manage to obtain credit insurance in environments where the risk, although substantial, may not be that significant. What do I mean by that? It could be substantial in terms of value terms, but the customers you're dealing with are very significant customers. And yes, there is an exposure, but you're paying for something that may not be justified in insuring.
Now, cash flow issues don't arise overnight, and on that basis, how far in advance should someone start liaising with their bank to see what options are available to their business?
Well, in terms of liaising with your financier, one of the key tools that all businesses should be using are cash flow forecasts, essentially listing out all the cash that's going to come in and all the cash that's going to go out over the next 6, 9, 12 months, ideally on a month-by-month basis. Even better if you do it on a week-by-week basis. That will turn around and indicate where the peaks and troughs are going to occur. And it's those troughs where you see yourself going into the red, where your outflows exceed your inflows together with wherever you started at the beginning. That's when you need to start engaging with the various providers of finance. It could be a supplier. You turn around and ask extended credit terms. Or it could be one of the financial institutions. The sooner you engage, the better.
And in the past, some businesses have sold and leased back assets to improve cash flow. But what are the pros and cons associated with this?
In turning around and selling and leasing back an asset, you have to be very careful that it's not core to your business. Certainly we've seen a number of companies sell non-core assets. So particularly you had the banks selling their bank branches and leasing them back because they weren't in the business of holding property. You also have other organisations selling back quite substantial assets, particularly transportation assets. So you're looking at things like ships and aircraft. But specialised machinery can also be sold and leased back. But the value in it depends upon the market that exists for that particular asset. You don't want to turn around and give somebody control over a very, very specialised piece of equipment that you may need in the future. You need to be very careful what assets you hand over control of. That having been said, it is important that all organisations look at their assets and make sure that they are turning around and getting value out of their assets. If there's cash tied up in an asset that isn't being utilised, why not sell that particular asset?
And Brendan, finally, unfortunately, when cash flow is a problem, it's not always possible to settle all bills on time, and therefore a business must look at prioritising such bills. What advice do you have in this regard?
If you discover that you're not in a position to pay your bills as they fall due, you need to be very, very careful, particularly if you're a sole trader or director of a business. Having fraudulent preference, it's a legal term. If you turn around and reprioritise your bills in an inappropriate fashion, you can run into some legal difficulties. So if it looks as though you're in a position where you cannot pay your debts as they fall due, it's very important that you pull together the directors of the company and you put together an appropriate plan.
That was Brendan Byrne of Sharbrand Services, and I sincerely hope that local business owners will take this cash flow management advice on board.
Southeast Radio's Business Matters with Karl Fitzpatrick.